Welcome back to another episode of the Ontario Mortgage and Real Estate Insights podcast. I am your host, Steve Hamoen. For those of you tuning in for the first time, I am an accomplished entrepreneur and certified 10X business coach. I am also the principal broker at Real Approved Incorporated here in Ontario, Canada. With over 25 years of experience in sales across various countries, I am here to provide you with the latest insights into the mortgage and real estate market. So, let's dive right in. Today, we're kicking things off with some important news from the Financial Post. The article titled Post Haste. Downturn expected to get worse before Bank of Canada rate cuts kick in brings some cautious news for our listeners. Despite the Bank of Canada cutting interest rates, the economic rebound we are all hoping for might take a while to materialize. In its latest outlook for the provinces, Fédération des Caisses Desjardins du Québec predicts that economic conditions will likely worsen before they get better. Economists Marc Desormeaux and Hélène Begin have stated, "We remain convinced that growth will soften in most provinces during the quarters ahead, and a fuller rebound will only come closer to 2025 once more cuts have been made." Changes to interest rates, whether they are cuts or hikes, usually take between 18 months to 2 years to work their way through the economy. The Bank of Canada has already cut rates by 50 basis points and is expected to cut at the next 4 meetings, bringing the benchmark interest rate to 3.5% by January. Although expectations of additional interest rate reductions underpin our forecast of stronger economic growth in 2025, the recovery is still in its early days, said the economists. Desjardins' forecast has the nation's growth in real gross domestic product hitting bottom at 1% by the end of 2024. It will be even lower for the provinces most sensitive to interest rates. The economists predict British Columbia's real gross domestic product will finish 2024 at 0.6% and Ontario at 0.9%. Even with the rate decline, many homeowners will see their mortgage payments go up when they renew, and savings rates in these two provinces are already climbing as residents brace for future rate shocks. The oil-producing provinces are expected to fare much better, with Newfoundland and Labrador leading the pack. Desjardins sees growth in the eastern province topping the charts at 2.2%, ahead of Alberta's 2% gain. Meanwhile, fears that the Canadian dollar would take a beating when the Bank of Canada cut rates ahead of the United States Federal Reserve have not amounted to much. For the most part, the Canadian dollar has weathered the storm, really more of a shower than a hurricane that was created by easing ahead of the Fed, said CIBC Capital Markets. CIBC foresees one more bout of loonie weakness if, as it expects, the Fed cuts only 25 basis points at its September meeting, less than the market predicts, while the Bank of Canada delivers its third cut. It forecasts the Canadian dollar will sink to 71.9 United States cents in the third quarter of 2024, before rising to 74 United States cents by the end of 2025. The loonie was trading at 72.74 this morning. So there you have it, folks. The economic outlook remains cautious, and while rate cuts are on the horizon, we may not see their full impact until closer to 2025. Stay tuned as we continue to monitor these developments and bring you the latest insights. Up next, we'll discuss whether homeowners are ready for mortgage renewals at higher rates. You will not want to miss it. Now, let's turn our attention to an important topic that's been making waves. Are homeowners ready for mortgage renewals at higher rates? Interest rates and borrowing costs might be on the way down in Canada, but many homeowners are still facing the daunting prospect of their monthly payments spiking when they renew their mortgages. For brokers, helping clients who are existing homeowners find a manageable rate upon renewal has been a common challenge throughout the year. This trend is only likely to intensify as we look ahead. According to the Canada Mortgage and Housing Corporation, a total of over $675 billion in mortgage loans will be renewed in 2024 and 2025 combined. That figure equals nearly 40% of Canada's overall gross domestic product. So, should borrowers and market watchers be worried about the Canadian economy potentially toppling amid next year's expected renewal surge? Speaking to Canadian Mortgage Professional after the Bank of Canada cut its benchmark rate on July 24th, Bank of Montreal chief economist Doug Porter said some borrower pain is certainly on the way, although it is likely to be contained and manageable. Porter noted that the renewal environment in 2025 is likely to be a challenging one. It is not going to be easy for people whose mortgage is coming up next year, almost regardless of what the Bank of Canada does, he said. Unless there is something horrible that happens to the economy, people who took out mortgages during the pandemic are going to be looking at rate hikes. They are going to be looking at higher payments. Still, the good news is that few, if any, borrowers are likely to be caught by surprise by the prospect of paying a higher mortgage rate upon renewal. The coming wave has been extensively discussed throughout this year and last, not least by the Bank of Canada. That means borrowers will already have been exploring their options in many cases, according to Porter. Porter added, "It is not going to be a shock to anyone. They have had a long time to prepare for that reality, and I think they are going to have options. Rates will be coming down. They might only have to lock in for a year or two and look forward to somewhat lower rates a bit further out." Leah Zlatkin, Chief Operating Officer and broker at Mortgage Outlet, notes that despite the Bank of Canada's recent rate cuts, the gap between fixed and variable mortgage rates remains significant. Prospects of much lower rates down the line received a boost last week, as slowing economic data in the United States and the possibility of a recession there saw markets begin to predict a higher Federal Reserve rate cut in September than originally expected. That could give the Bank of Canada greater leeway to trim its own benchmark rate in the months ahead, although Porter and Bank of Montreal senior economist Robert Kavchich said in a note that the Canadian Central Bank is already a step ahead of the game after first lowering rates 2 months ago. Fixed rates have slipped over the past week in response to the gloomy economic news coming from the United States, while further Bank of Canada cuts would have a direct impact in bringing variable rates lower. Whatever the case, with little indication that rates are set to spike again anytime soon, Porter said the outlook for homeowners renewing looks at least marginally better than it did while the bank was firmly in the midst of a rate-hiking bias. Porter concluded, "I do think we are past the period of maximum pain, and people whose mortgages are coming up for renewal next year will have some options. They might not all be great options, but they will have some options that I think will be manageable for most." Now, are high rates causing many homeowners to list their property? To what extent has an uptick in new listings reflected the reality of homeowners grappling with burdensome higher rates? According to Royal Bank of Canada Assistant Chief Economist Robert Hogue, those rates have had some impact on the market. In a recent report, Hogue said supply had improved, particularly in Toronto, mainly because of the completion of newly built units that owners wanted to offload. Hogue added, "In other cases, it could be sellers betting lower rates will spur buyer interest and improve sales outcomes. In some, it may be a sign of homeowner distress arising from high rates." Let's dive into some fascinating news about the value of Ontario's real estate market. According to a recent report from the Municipal Property Assessment Corporation, the combined value of Ontario real estate is now estimated at a staggering $3.14 trillion. This is a significant increase from the previous year's tally, which was up by $42 billion. One of the key drivers behind this increase is the booming construction activity in various parts of the province. Take, for example, the new construction at sites like 407 Dundas Street West in Oakville. Developments like these have contributed substantially to raising the value of Ontario's real estate. Toronto, in particular, has seen a notable rise in property values. The city's property values have climbed to $9.93 billion, according to the same report. This surge underscores the continuous demand for real estate in one of Canada's most vibrant cities. The Municipal Property Assessment Corporation, often referred to as MPAC, plays a crucial role in assessing the value of properties across Ontario. Their assessments are not just numbers on a page, they directly influence property taxes and, by extension, municipal revenues. So, these increases have far-reaching implications for local governments and residents alike. It is also worth noting that the rise in property values is not uniform across the province. Certain areas are experiencing more rapid growth than others. This uneven growth can be attributed to a variety of factors, including local economic conditions, availability of land, and the pace of new construction projects. For investors and homeowners, this data is a goldmine of information. Understanding how property values are shifting can help in making informed decisions about buying, selling, or investing in real estate. It also provides a glimpse into the economic health of different regions within Ontario. So, what does this mean for you? If you are a homeowner, the increased value of your property could mean higher property taxes, but it also means your asset is growing in value. For potential buyers, it is a signal that the market remains robust, and for investors, it highlights areas where opportunities for growth are abundant. As we continue to navigate the complexities of the real estate market, staying informed about these trends is crucial. The $314 trillion valuation is not just a number, it is a reflection of the dynamic and ever-evolving landscape of Ontario's real estate sector. We will keep monitoring these developments and bring you the latest insights. Up next, we will discuss the new interim CEO named by the Ontario Real Estate Association. Stay tuned. Let's dive into some organizational news from the Ontario Real Estate Association, or OREA. Tim Hudak, who has been at the helm as Chief Executive Officer for 7 years, is stepping down. Hudak joined OREA in 2017 and has been instrumental in modernizing the association's operations and laying a strong foundation for innovation within Ontario's real estate sector. His term was set to end on August 2, 2024. The OREA Board of Directors has taken this opportunity to search for his successor ahead of the next phase of the association's modernization efforts. They have initiated a comprehensive search process, both internally and externally, to find the next leader who will continue to drive innovation and growth in Ontario's real estate industry. In the interim, OREA has named Sonia Richards as the new interim CEO, effective August 12, 2024. Richards is currently OREA's Chief of Staff and Board Strategy, and she brings a wealth of experience and industry knowledge to the role. She has been a key figure within OREA, managing critical operational aspects and helping to shape the association's strategic direction. Rick Kedzior, president of the OREA Board of Directors, expressed his gratitude for Hudak's contributions. He said, "Tim's leadership has been critical to the progress OREA has made in streamlining Ontario's real estate sector and positioning the association for the next phase in its advancement. As the board progresses in its search for Tim's successor, I am confident that Sonia's experience as a seasoned industry leader and her substantial expertise in leading critical operational aspects of our organization will serve OREA well in her expanded role as interim CEO." In her new role as interim CEO, Richards will oversee the day-to-day operations of OREA while continuing her duties as Chief of Staff and Board Strategy. Her responsibilities will include fiscal oversight, business planning, program management, and fostering strong relationships with member boards. Richards will be supported by the full leadership team, including General Counsel and Privacy Officer Allison Byrne, Vice President of Operations Ruben Thena-Ruben, Vice President of Partnerships Luigi Favaro, Vice President of Public Affairs and Communications Blue Knox, Head of Human Resources Wajiha Hussain, and Head of Finance Amar Dotar. So there you have it. The Ontario Real Estate Association is in a period of transition, but it is clear that the organization is well prepared for it. With Sonia Richards stepping in as interim CEO and a robust leadership team in place, OREA is poised to continue its mission of driving innovation and growth in Ontario's real estate sector. That wraps up today's episode of the Ontario Mortgage and Real Estate Insights podcast. I am your host, Steve Hamoan, and I want to thank you for tuning in. We covered a lot of ground today, from economic forecasts and mortgage renewals to the staggering valuation of Ontario's real estate market and the latest leadership changes at OREA. Stay informed, stay prepared, and until next time, take care.